Hey guys, what's going on, man? It's a beautiful evening here in Alabama. You notice I've got a sweatshirt on because it is so cold outside. Trying to see what the temperature is. It's 30 degrees out there. I know that sounds like it's not like really cold, but it's cold for us. I mean, it was this past week was in the 70s. Now all of a sudden it's 30 degrees. But I guess it's good for the bees. They get to kind of hunker down and not use a lot of energy. And so I'm excited about that. So I thought tonight, what we would do is we would talk about just the portfolio update. I don't think I've shared with you guys in a while. I haven't made a lot of transactions, but it's always good to refresh our memories. I thought I'd go through the portfolio briefly, just so you can see what I'm holding, what percentage of the portfolio it is, and how well or poorly it's doing. And then the second thing is, let's take a look at the top 10 stocks in the model. And, maybe it gives you some ideas. Maybe it doesn't. We'll just have to see. So let's get started. We will hit. I guess I should start sharing some screens here if we're gonna do this right. There we go. Now that's a lot of numbers, isn't it? That's my dashboard, just for those who care. This is the portfolio, and today I'm trying to make it bigger so you can see it. Today the portfolio went down 1.1%. That kind of stinks. Almost $20,000. The S&P was down 1.04%. NASDAQ was down 1.13%, and the Dow was down 1.66%. My worst performers of the day were Intuit, down 5.5%. And I want to talk about that here in a few minutes. U.S. Bancorp is down 4.84%. Visa is down 4.57%. Microsoft is down 3.21%. And T. Rowe Price down 2.43%. Those are my biggest losers of the day. Biggest winners were Hershey's 1.94%, Johnson Johnson 1.38%, Atmos Energy, which is just a stalwart in the portfolio, up almost 1%. Northrop and then Lockheed Martin were up just a fraction, almost 0.5%. So that's it. That's what happened today. It kind of stinks some days when you lose 20,000, but it kind of makes up for it when you make 20 or 30, on the way up. So where are we at year to date? The portfolio has actually brought in, it's brought in terms of dividends and interest about almost $2,600. But it's brought in almost $42,000 worth of capital gains. So in total, we are up $44,493 year to date this year, which is roughly 2.64%. But when we started the day out, we were up 3.77. So, go figure. All right. So that's what happened today. But that's not why you came. You came because you wanted to see the top 10. Oh, man, that is really small. It's funny how that gets really small on the screen, but on my monitor it looks great. But okay, here we go. The top pick and we're just going to do the top 10. So I'm going to do through line 11 here, and I'm going to hide the rest of this. The model looks at 131 stocks and it ranks them. But we don't have time for all that. Let's just hit the top 10. See what the model says we should be buying right now. And I will tell you, sometimes the model's good, sometimes it's not so good. You have to use your own judgment. And, and I've done that. Let's start with the first one, Intuit. Intuit's number one. The model says it's going to have an annual return of about 41%. Now, analysts are saying 112%. Normally, I think, wow, they just haven't caught up with the times. But there's been a lot of analysts out there who are reiterating their price targets for Intuit. They're saying this is just an overblown, reaction to AI. So I don't know. I'm kind of thinking that myself. And right now it's 1.53% of the portfolio. I am considering doubling that at some point. I do not, however, want to catch a falling knife. And if we were to look at a chart of how Intuit is done, actually, we could probably do that here. This is the past 30-day trend. And if I look at this line here, you can see the Intuit line there is just been going down, down, down. So that's not a great looking chart. It's 45% of its 52-week high. So that's not good either. But at some point, it's worth something, it's got to be worth something, right? So the question is, what is it worth? So according to this model, it is a buy. Let me just kind of walk through some of the metrics here. It is wide moat by Morningstar. It is 50% of its fair value. 50% of Morningstar's calculated fair value. So that says something too. Now the return on invested capital has been about 16%. That is not shabby. It's got a medium fair value uncertainty, which means that when they're valuing these things, like for instance, ServiceNow, which is the next stock on the list, has a high fair value uncertainty. That means they don't know, it's got a lot of volatility. So they're not really sure from a business perspective. But, Intuit is about a medium, and the dividend safety is a 98. Payout ratio is 21%. So, it's got some really good numbers. But even now, the dividend yield's only 1.3%. So if you're looking for yield, Intuit is not the right stock for you. But if you're looking for some potential, if you are a value investor, a stock that is trading 50% of its fair value, that's the definition of a value investment. The only question is, is it going to come back to, or is it going to actually make it to what they believe the value is? I think it will eventually. And so I am looking to increase my stake in Intuit. I will probably double it. I don't know if I'll do it all at once or if I will just do it, in dribs and drabs. But I'm planning on investing a little bit more money into it. Now, ServiceNow is also a software as a service company. I kind of think of them very similarly, and I'm choosing at this point to invest into it. So therefore, even though ServiceNow is it says it's the third item, but it's obviously there's a header line. So it's the second stock on the list. But even though it's the second stock on the list, I think they have a lot of the same attributes, characteristics. They're being impacted by the same issue, which is this whole idea that AI is going to take over the world, and all the companies that provide service from a tech perspective are going to be impacted by that. I just don't believe it. I think these companies are going to be able to leverage AI to make it much more competitive and much more cost efficient to provide the services that they provide. But I don't think AI is going to take over the industry. So, but that's just my opinion. That's the beautiful thing about investing is we get to make our own minds up. So I'm just telling you my thoughts. I'm not recommending anybody buy into it. I'm just saying that I plan to do it. And that's what you came for, is to hear what I'm doing. And if you like it, you can, keep it. If you don't like it, you throw it away. But at the end of the day, we're just friends chatting about what we're doing in our portfolios. So we talked about the first two. The next one actually is Comfort Systems. I'm a little bit leery of investing in Comfort Systems. I have been for a long, long time. Although the model says it's a 29% potential return, it does have a narrow moat, and it is a 36% higher than its fair value. So I mean, it has a phenomenal return on invested capital, 35%. It does have a high uncertainty value, and it does have an 80 for its dividend safety score and a 7% payout ratio. So that's pretty good. But its dividend, again, is 0.2%. Not much to speak of there. It has been growing it like crazy, though. I think let's take a look. Sorry to whiz all these numbers by you here, but Comfort System has been growing its dividend by, on average, over the last 5 years, 35.6%. That's a lot. So they've been growing incredibly fast. But again, they are way overvalued from my perspective. So it's a little hard for me to pull the trigger on them. Now, the next one on the list, believe it or not, even though, let's take a look at how we've done on Amphenol. We are up 123.95% on Amphenol. We bought it roughly a year ago. So over the last year, it's up 123%. Now, today it was down 2.1%. But, we ride those things in and out. It's no big deal. But, at the end of the day, Amphenol, even though we're way up on it, it's still showing as a buy in the model. I know it says hold here, but I didn't update these. That's a manual update for me. So I'm gonna hide that because I didn't update it. So Amphenol is it says it's going to be a pretty big winner. It's a wide moat. And for those of you who don't know what Amphenol does, they basically provide electronics that support AI. It's really more hardware type electronics to AI. And they have a wide moat. They're at about a 13% discount off their fair value. So it's, a reasonable time to buy. 16%, again, return on invested capital, similar to Intuit, and medium fair value uncertainty. They have an 87 dividend safety and then a 22% payout ratio. Only a 0.7% dividend yield. So if you're looking for high yield, again, this is not the stock for you. But if you are like me and you want a little bit of dividend income, but you also want some really nice potential gains, it doesn't sound like a bad deal. Let me take a look real quick. Fair value 3.8. Yeah, so their growth is really driving the boat here. So they are what I would consider, even though they pay a dividend, I consider them a growth stock. So if most of this 28% potential return is coming from growth, and so I if I didn't already own 5.86% of the portfolio in Amphenol, I would probably add some. But again, for those of you who don't know, my rules are that I look to be 2.5% of the portfolio in any position. That would be a normal weight of a portfolio position for me. If I want it to go higher, if I want it to be stronger part of the portfolio, I can go up to 5%. And then if the stock grows it past that, I'm okay with that. But at some point, once the investment thesis cools off a little bit, I need to pull that back down. And I had already pulled it down for Amphenol. If you guys remember, it was up around 6% of the portfolio. I bumped it back down to 4%, and here it is back up at 6% again. So it's been heating up really nicely. I'm going to leave it. I'm going to let it continue to ride. I don't know. What do you guys think? You guys interested in Amphenol at all? Amphenol at all? The next one is Cormedics. The analysts are saying 112%. I'm not really buying that. I think it's really more like 25%. They don't have a moat. They do have 6 products now, and they're not just one. This is for those of you who like really small startup companies that have a lot of potential return. They don't pay a dividend. This is the only stock I own that does not pay a dividend. So it's kind of hard to get a beat on it. And I'm way down on it. I think we'll look at it here in a minute. But I'm not concerned about that. This is a long-term investment for me. I will likely also double this to get it to be a normal weight in the portfolio, about 2.5% or so. But it's about 38% below its fair value. So I'm okay with that. Now here's a new one that's kind of worked its way up. It's called automatic data processing, ADP. They're really I think 70% of their business has to do with payroll type stuff, including filing tax returns, the 940s, 941s, the state unemployment and federal unemployment tax returns and things like that. So they are big into that. And then about 30% of their business, if I remember right, has to do with them actually having, how do I say this, being a contracted third party to companies who want to have them own, or not own, but have them hire the employees. So ADP, 30% of its business is I guess outsourced contract employees. So I haven't looked into it any further than that, but it looks like it's got a lot of potential, and I'm considering doing a little bit more deeper dive on that. They're 20. The model says 25%, and the analysts say 38%. It's got a wide mode. It's about a 31% discount to its fair value. Return on invested capital is 39%. Is really smoking. I know there's some concern that it's going to be taken, that it's going to take some fire from these up and coming HR modules, and it might. I don't know. It's got a medium uncertainty. Dividend safety is 90. The only downside is that their payout ratio is about 61%. So that is about the max that I would want for a company. Especially one, well, it's got a 3.3% dividend yield, so it's not so bad. So if you're looking for a kind of a market-beating dividend yield, that is a market-beating dividend yield at 3.3%. But again, it is paying 60% of its earnings in dividends, and it gets to be a little bit scary for me to invest in companies who are paying a lot of their earnings in dividends. I want them also reinvesting earnings into the company. I'm happy to share in those earnings. Some people want as many dividends as they can get. I want the highest total return that I can get, which means that I do want some dividends. I want them to acknowledge my investment. I want them to give me some return on that. It doesn't really have to be a whole lot, but I do want some, and I'm happy to share and let them grow the business with the rest of it. So, but 60% to the dividend payers seems to be a little bit on the high side. So still on the watch list. I haven't pulled the trigger on that. Now, Microsoft is 4.79% of the portfolio. It has worked its way back up into the top 10. So it might be worth buying some more. Although I don't have a lot of headroom here, with my rules. 4.79% is awfully close to 5%. So I don't have a lot of wiggle room there, but it does seem to indicate that it's got some running room. It's about 36% discounted off of its fair value. It's got a 22% return on invested capital, a 99 dividend safety rating. I think it's only one of maybe 2 companies that has that. Johnson & Johnson being the other one. And I'm drinking little Aquafina tonight. Payout ratio is only 23%. So I'm going to hang in tough on my Microsoft. If I buy any more, it'll just be a small amount. I have 220 shares. So I don't know, 10%. I don't know. I don't know if I'll buy any more or not, but I'm not gonna sell. So the next one is Humana that's on the list. I'm a little bit concerned about all of these healthcare stocks, whether it's United Healthcare, Humana. There's another one. I just invested in it. I can't remember what the name of it is. It's the old Aetna. But anyway, I'll think of the name of it here in a little bit. So I'm going to hold off on anything related to healthcare until, some of there's just a lot of interference that can come from the legislative process, the governmental legislative process. So I think I'm going to let those fly for the time being. Broadcom is one that's on my list. It is 22% potential return. Analysts are saying 39%. It's a wide moat. 31% discount to fair value. Return on invested capital is 14%, which is not too bad. It does have a high uncertainty rating, though. Dividend safety is 67 and a payout ratio of 35%. But again, not much in terms of dividend yield. So it is definitely a growth play for sure. Then last on the list, and I think it actually, it pushed out the when I was looking at this earlier today, preparing for this discussion tonight. The number 10 company was Hess Midstream, so Accenture actually pushed Hess out of the way, and it's because it went down almost 7% today. So that means that if their fair value, which really doesn't change on a daily basis, the market prices change, but the fair value really doesn't, as long as we can kind of get a sense of what that fair value is. So when they move like 7% like that, it actually drives more potential return in the future, because the fair value is what it is. So we got 22%. We got 49% is what the analysts are saying. It's a wide moat, 74% fair value percentage. So it's that'd be a 26% discount to fair value. Return on invested capital is 22%. It's got a 92 safety rating, dividend safety rating, and a 47% payout ratio. Now, why do I have Accenture on my list of 131 stocks or whatever it is? It's because they are a play into AI from a consulting perspective. So they don't really have the AI products, but they are utilized. They have the technical expertise in AI that companies are using on a contract basis. So they should do well in the AI environment. But anyway, so those are my top 10. What do you guys think? Are you planning on hitting any of these? Are you staying away from any of these? Should I have the skull and crossbones on any of these? Give me some feedback. Let me know what you guys are thinking. Now, before we go through the portfolio, these are the top 10. Before we go through the portfolio, let me see who is on the line. We got, here we go. We got my friend Brad Durfee. Good to see you, man. Hope all is well. And Billy Johnson, look who shows up. Yeah, open the door and look what the cat drug in. That's a saying here in the South. They probably don't have that in the Philippines. But Steve C is on. Good to see you, buddy. Bernard, hey, what's happening, man? We got Triven here. Thoughts on FDS? I'll take a look at that. Let me put that on my list here. FDS. Yeah, I'll take a look at it. Be happy to do that. Triven bought $100 of ACN Accenture today. So good, dude. So you must have some confidence in the future of ACN Accenture. So I'm warming up to it. I don't like to own a lot of stocks. I like to keep it below 25. And if I look at my handy dandy dashboard, I can get my cursor over there. I own 21 stocks at the moment. So I've got some room to add, a company or two. I can possibly even take a company or two down as well and get out of them if I wanted to. So we'll see. Fast Eddie is in the house. Good to see you, my friend. Yes, sir. It was a rough day in the market. but it's okay. Or I say we, and me and this mouse in my pocket. The I think as a long-term investor, I see days like this as opportunities to kind of look and see if there's something I can pick up for discount. And I'm thinking, Intuit is one of those. When we look at the portfolio, we'll talk through some of that. So, yeah, it was a rough day in the market, but we're going to hang in there, man. This is, like I say, the portfolio is up on the year through the end of today, by 2.64%. We are what would that be? 7 weeks into the year. So we're 7 weeks into the year and we're up 2.64%. That would roughly be, what would that be? I'm going to do it this way. I'm going to pull up my handy dandy calculator. This will be wrong in all sorts of ways, but it'll be close. Sometimes doing close math is okay. So 2.6% divided by 7 weeks times 52 weeks. So if I could do this the rest of the year, we would be at 19.3%. I'll take that all day long. You know what I mean? So even after the huge drop today, we're still on a pace for 19% returns this year. You know how that goes. But what I'm saying is that 2.64% through today, I'm okay with that. A little bit of volatility there. But let's take a look at this. I'll show you how that volatility, at least the way I look at it. How do I look at volatility? There we go. Oh, right. There we go. And it's so small you can't see it. I don't know what the deal is with that. But anyway, you can see what the portfolio's done. What is that called? The Russell 2000 is that blue line. And they, at the first few weeks of the year, they just went nuts. They went crazy. They've traded pretty flat the rest of the time, but it just takes a while to catch up to that. And you can see the green line is our portfolio. So let's let me move this over just a little bit so you can see. So you can see that we are at 3.77%. Now this was as of Friday. For whatever reason, my brokerage does not update until overnight sometime. And so when I do this on Monday, the latest data I can get from the brokerage is on Friday. So that's what this is. And that's why in my model, you see that the portfolio value is like 2.6 or something like that. So, but yeah, 3.77 through Friday, 3.44 is Dow Jones, 1.11 was the S&P. So I bet the S&P is now almost zero again. NASDAQ is down 1.47. And then, like I said earlier, Russell is up 7.44. It's just nuts. But then, so I look at it just on the raw returns. We are beating 3 of the indices, trailing in the 1, which is the Russell. And then I look at it on a risk-adjusted basis, which kind of factors out volatility, which, we're beating every index on that basis. So I'm good with that. I think the portfolio is performing very well from my perspective. So. Okay, there we go. Come back over here. All right, let's see what else is going on here. We got Brad. Yeah, Microsoft. Like you, I'm holding but not accumulating more. Yeah, I think that's a good call, Brad. I mean, if I didn't own Microsoft, I would buy some, but I do. I own. It's actually near the top of my rule in terms of how much I own in an individual stock, which is the 5% rule. So, yeah. Oh, my buddy Russ is here. Any worry that AI can do coding and data analysis faster and cheaper than the teams of consultants they currently bill by the hour. Yeah, I, don't- I, I guess the way I see it, Russ, is that I don't sense that there were a lot of coding people in Accenture. Having worked with these guys, I worked with Accenture. I've worked with um, Ernst and Young. I've worked with PwC. All of these firms, they rarely do a lot. You know what I mean? It's more strategy. It's more laying out a plan. It's more, So I'm thinking that they are laying out strategic paths for AI, and there may be some technical work, some work there, but I don't think that's the lion's share. I think the big money piece, they in terms of work, it might be more work, but I think the big money piece is going to be in strategy. It's going to be how do they take this further. So, but yeah, I mean, is there concern? There's concern in every investment I have. It's uh, I don't know. I don't know if I knew exactly what would happen, it wouldn't be as fun. Yeah, so I don't know, man. You may be right. They may it may cannibalize. I think that's what you're trying to say, is that it's cannibalized, potentially could cannibalize the consulting business of Accenture. I think it's probably going to not do that. I think it will. I think, as just like the internet, as it grew, the need for understanding how to use it differently and better and derive the most value out of it goes up. And so if you've got people who have the potential to be able to do that, like Accenture does, I think there's going to be some demand for that thought, and maybe AI gets good enough to where they can say, here's the strategy, and you humans just sit back and go play some video games while we run the world. I just don't think that's going to happen. I don't think as humans we are going to be okay with that. So we'll see. We'll have to see. We'll see where it heads. Fast Eddie, in a year and a half, I will start drawing on mine. That's when things can get a little rough. Yeah, I hear you, man. The way I looked at mine, Fast Eddie, is that I decided that if I was going to draw income, I wanted it to come from dividends. And so what I do is I determine how much in dividends I want to live on, and maybe you've got other streams of income. And so let's just make something up. Let's say that your total need for the year is $50,000. And let's say you've got some other sources of income. You got a rental property, you got, some kind of retirement coming in. And let's say that, let's say that's 40,000 of that. So you need 10,000 in dividends, or 10,000 from your investments to kind of, and these numbers aren't even going to be close to right, but I'm just trying to think of an example. So you would then need $10,000 worth of dividends. I would figure out the companies I want to invest in to get me $10,000 worth of dividends. And those are going to probably be higher yielding dividends, but again, companies that still have some growth to them. That's kind of the way I look at it. So then I would pull down my dividends and let my investments run. I don't want to be pulling money out of my growth assets. I want it to be coming from what the company's paying me, if that makes any sense. Now, whether that's the right way to do it, I don't know. It's just the way I do it. It seems to work out okay. I don't want for anything, so that's good. We set our budget, and that's the way it works, man. Yeah, Accenture is on my watch list as well, and yeah, that's certainly a big concern. I agree with you that I don't have a good answer for you, but so Fast Eddie's got a question for me and Russ. What hurts more, something on your watch list you didn't buy and it keeps going up, or something you bought and you can't figure out why it keeps going down? Yeah, I think it's both. I don't know which hurts worse. But I call that the perpetual feeling of regret. So as an investor, no matter what I do, I'm going to have regret, or as they say, regrets. I'm going to have some regrets. And if I buy a stock and it goes down, I regret having bought it. And a good example of that is, we talked about it just a second ago, is Intuit and Coremetics. So I'm down on both of those stocks. So I regret having bought them at the time that I bought them. So they are down, and so now I got to figure out how to make this work, right? So I regret that. But if I had bought them and they doubled, I would regret having not bought more, right? So if I only bought 100 shares and they doubled in value, man, I regret not having bought 200 shares, 500 shares, 1,000 shares, right? So there's this perpetual regret. If I buy it and it goes down, I regret that. If I buy it and it goes up, I regret that. What if I sell it? If I sell it and it goes way up, then I regret having sold it. And if I sell it and it went way down, then why didn't I sell it all, or why didn't I short sell, right? So there's this like perpetual regret that happens as an investor. And then, there's also the regret, and I didn't think about this really until you just said it, that, and there's several, like Texas Pacific Land. I think my buddy Michael from Houston kept saying, hey, we need to look at Texas Pacific Land. I was like, yeah. And I'll cheat here and go see what it has done this year to date. Give me just one quick second. TPL. Let me look at it year to date. Yeah, so here, I think I'm actually going to show you because it really sucks. Hold on a second. Let me get it on the screen that you guys can see it. Here we go. You ready? All right. Texas Pacific Land. Here we go. I'm about to show you the screen. All right. Be easy now. Here we go. All right. Texas Pacific Land. This year to date, it's up 75.07%. 75%. Now, my buddy Michael was trying to tell me, he was like, dude, you need to invest in this. And I was like, yeah, it's got, concerned about this, concerned about that. But at the end of the day, it jumped year to date by 75%. That's in 7 weeks. So, but he invested in it, and I'm so happy for him. He made a nice return on that. So well done, Michael. I appreciate it. Appreciate the advice, and I regret not having taken it. So they all hurt, Fast Eddie. They all hurt. It doesn't matter. It doesn't matter which one, But we have to make the decisions we make, and we can't really get tied up in the what woulda, shoulda, coulda. What we get tied up in is, how's my portfolio performing against the market, against indexes that we care about. Now, my goal is to make 8% a year, and let's take a look real quick. Let's see where I'm at. My model actually calculates this for me. Here, I'll share this. Okay. So here we go. This line right here. This is the annualized return since January 1st of 2021, which is when I retired, roughly when I began investing out of retirement, when I began to actually when I became the chief investment officer of our family, and I took investing seriously and started, researching stocks rather than spending all my time trying to figure out how to do my job better, I invested time in stocks. Since then, it has grown 13.3% on average. And I'm looking for 8%. So I'm doing pretty good there, and then overall I'm beating the S&P. Overall, I'm beating and even with the way it's grown, I'm beating the Russell 2000, the Dow. So I'm doing okay, and I feel pretty good about that. But I think at the end of the day, we measure ourselves not against the woulda, shoulda, coulda. We measure ourselves against the market, or our targets, or both. And if we like it, then let's stay with it. And if we don't, let's just put the money in the market and let it roll. That's kind of the way I think about it. Russ here says, definitely bothered by something that I didn't buy that goes up more. Yeah, so maybe, they bother me all. If I bought it or not, it doesn't matter. It all bothers me the same, which is really not a lot, because at the end of the day, it's going to be okay. We're investing in solid companies with great strategies, with great management teams that have good execution, that have solid financial statements. So at the end of the day, even if the stock price goes down or if it went up and I didn't buy enough, at the end of the day, I still own a good company. So I feel good about that. It says NVO goes down and LRCX keeps going up. I'm not really sure I understand that one. Yeah, I'm not synapsing on that one. So Trevin got some TPL. Yeah, exactly. Trevin, you got that regret going on, man. You regret not buying more. So, but congratulations, dude, on that TPL. That is awesome. That is awesome. So let's take a look real quick at the portfolio. I promised we would do that. And here it is. Boom. All right. So I'm going to make this a little bit bigger so you guys can see it. And now I've got to move it back this way. There we go. How about that? Yeah, I think you can see that now. So the and these are in alphabetical order. These are in alphabetical order. Alphabet. And speaking of alphabetical, it's Alphabet is first, which used to be Google. We have about 330 shares of that. Market price $311. Market value doesn't really matter. The portfolio, it's 5.8% of the portfolio. And today it was down 1.1%, but overall we're up 96.8% on our investment in Google. Amphenol, remember we talked about that. As I've been in it about a year, 700 shares. It's 5.9% of the portfolio. It was down 2% today, but overall we're up 124% on that. Atmos Energy, which has just been a stalwart. It never like shoots the moon, but it's always just steady eddy growing and going up. Today it went up 1%. Overall, we're up 83% on the stock. So, and then it pays a dividend of some number, probably 3% or so. So, we'll take that. Actually, my spreadsheet, if you guys don't mind a diversion, let's take a look. What was the name of that? Atmos. Yeah, let's take a look at Atmos. This is historical. I think I should put on here some trigger that says when I first started investing in it. But Atmos has been a pretty good while. So I would say 4 years, maybe 4.5 years. And if you look at the unrealized returns, it's 26,000. And then the dividends are 32 2,500. So total is 28.9. So almost 30 grand on Atmos Energy. So, somewhere in the $7,000 to $8,000 per year range. And I've got 5,600. So it's been growing, 10% in the portfolio. So I will take that any day. You need some of those in your portfolio. So that was Atmos. Carlisle is, I'm actually making money on Carlisle now. It was a loser there for a while, and then all of a sudden it wasn't. So it is 3.4% of the portfolio. We were down 2% today, but we're up 16% overall. I just started investing in it probably 3 or 4 months ago. And Cormedics is one of those started, about 3 months ago as well. We are down significantly on Cormedics, 28%. It went down 0.28% today. At some point soon, market price is 7. My cost basis is 977. At sometime soon, I'm going to probably double the investment because we're at 1.4% of the portfolio. I'm going to get it up to about 2.5%, 2.8%, and get that cost basis down and see what happens. They report earnings, I think, on the 26th, which is 2.5 days. So let's it's either going to be good or it's going to be bad. So that's kind of what I'm thinking on Cormedics. I'm going to get that cost basis down. Maybe get it to where it's about that sound means that somebody's home. Get it to where I'm maybe 14% down. And then if I can get a nice bump in the stock, then I'll be in pretty good shape. So that'll be my strategy around that. Now, EOG, I want to hear you guys' thoughts on EOG. I've owned EOG for 4.5 years now. And when I first bought it, it was going up, like crazy. It was paying these special dividends like you wouldn't believe. And it was a great investment. I think maybe long term it's okay, but it has not been doing well here recently. So I'm wondering if it's something that I should jettison and move into something different. What do you guys think about EOG? Do you have any? I'm up about 37% overall. And these are just capital gains. These do not include dividends. So I'm up about 37% overall on EOG. Let's go and see how many dividends I've gotten off of that. So I've got unrealized gains on this investment of $7,500, and I've got dividends of $5,300. So that's pretty solid. But EOG, let me know what your thoughts are on EOG. General Dynamics is my next one. It is 2.1% of the portfolio, down 0.67% today, but overall up 77%. I'll take that. Hess Midstream is up 0.24%. We're up 20% overall. Now, Hess, my guess is, let's take a look. EFGH. Hess Midstream is right there. Yeah. So this is one that I have. I have $9,600 of unrealized gains. I have $400 of realized gains. So let's say that's $10,000 of capital gains, realized and unrealized. I've got almost $11,000 worth of dividends. So it's a stock that has been a great total return because I'm getting 8% or 9% in terms of dividend return. And I'm also getting that in terms of stock returns, even though it's had some struggles lately. So, Hess Midstream is knocking it out of the park for me. Intuit, haven't owned it very long, couple of 3 months, down 42%. So, wow, it went down 5.5% today. At some point, though, guys, it's got to be at a value that it's worth. And so, fortunately, I haven't pulled the trigger. But at some point, I will want to double my investment, get this down to about a 21% capital gain or capital loss so that I can, look to recover those investments. SOX is the next one, which is the semiconductor ETF that I use. We're up 104% on that. Johnson & Johnson, we're up 69% on Johnson & Johnson. It's up 1.38% today. It's 3.5% of the portfolio. I'm looking maybe at possibly bringing that back down to the 2.5%. What do you guys think about that? Lockheed Martin, we're up 88% on that. Microsoft, we're only up 17.9%. That's shocking because we were up a lot more than that earlier this year. But I mean, we're still up, so it's all good. Northrop Grumman, we're up 48% on Northrop Grumman. I didn't start it until it's been less than a year on Northrop Grumman. Parker Hannifin continues to just rocket out of control, 231%. It's just been one of my better investments of all time. RTX up 137%. Now, T. Rowe Price has taken some hits here lately. It is only up 7% overall. Hershey, 3.2%. But, I mean, let me back up. T. Rowe Price is only 1.1% of the portfolio. So it's not like I have a huge conviction there, but it is one of my higher yielding stocks. And I use those dividends to pay for stuff that I want to pay for. So Hershey is 3.2% of the portfolio. We are up on Hershey 23%. So that's not so bad. U.S. Bank, we're up 58%, but they went down 5% today. And VU, I have a third of my portfolio is in the S&P 500. It went down 1% today. We're 55% up in total on the open shares there. And then Visa, we're up 15%, but it went down 4.5% today as well. So pretty rough day overall. I mean, we're comparable to market in terms of that, but we're still, swinging pretty good. I've got 2 stocks in the portfolio that are currently underwater. One of those is Cormetics and one of those is Intuit. And I, think the way that I'm going to get to those is average down and see what happens. I think that sounds like a pretty decent strategy. Who knows? We'll see. Let's see what else you guys have, and then we'll call it a night. Let's see. Hey, Michael. Yeah, we were talking about you a little bit earlier. Or I was. If you didn't hear, I gave you a lot of kudos for telling me I should be investing in Texas Pacific land earlier this year. Or I'm sorry, later last year. And I never pulled the trigger. And you're up 75% year to date this year. So well done, my friend. Good job. So, Billy, you have EPD. Oh, I forgot. We need to look at FDS for Triven. And so, Triven, I have not forgotten about you. Yeah, EPD, Enterprise. I think that's Enterprise Resources. That's a pretty decent investment as well. EOG's the only good thing that came out. Yeah, that's true. Yeah, the only good thing that came out of Enron, but I'm not so sure it's better than other stuff that's out there. That's kind of where my head's at. So of all the stocks that I own, Russ is asking which one would I be the most comfortable buying right now? I think Intuit is probably the one I had the most comfort with, and it's for several reasons. One is I do believe in their strategy. I believe in their management team. They have solid financials, and I think they're caught up in a market sentiment that is downward. The question is, how far does it go? Do I catch that falling knife, or is it hitting the bottom? Do I wait until it hits the bottom and works its way back up a little bit? That's a question. But at the end of the day, I feel comfortable buying it because I think it'll improve my cost basis so that I can turn that around and make some money on it in the long run. So if I had to buy one, that's what it would be, and that's what I've been looking at in my portfolio. So, yeah, that's not enterprise; it's energy products partners. Yeah, I'll have to look into them. I'm not pulling them up off the top of my head. So let's look for Triven at FDS. How do we want to do this? We want to do it like this. We want to go first of all to our friends at Simply Safe Dividends. So FDS, Fact Set. I don't think I've ever seen them before, but let's take a look, Triven. This will be kind of fun. It's a financial company, financial exchanges and data. They've got a 95 dividend safety rating. They've got a dividend yield, which is kind of maybe right at a market dividend yield of 2.3%. They grew their dividend by 5.8. Let's see what it's been on a 5-year basis. Oh, 7.5%. So that's pretty good. Let's take a quick look. This is the way I would do it if I were just looking for myself on this. I would look at their payout ratio. It's about 25%. Their earnings have been going up. So one of the things that I look for is this earnings payout ratio to be flat. And what that tells me is the dividend growth is very consistent with the business growth. So I can kind of count on that business growth because that's what the business is willing to pay me for it. Is 7.5%. So 7.5% plus a dividend yield of 2.3%. So that gets me about 9.8%. And then let's take a look at Morningstar and see if they cover FactSet. And they do. They say it's a 5-star stock, which means that they are trading at a 46% discount. Dude, that might be a good thing to add to my model. So it may be similar to what's going on with my Intuit. So I don't want to kind of overexpose myself to that, but it looks really good. In terms of potential return, it looks really good. So, dividend safety is good. Let's take a look at some of the other factors. Sales growth, it's continually growing, so that's good. Shares outstanding are pretty flat. Sales are growing. Return on invested capital is around 16%, very similar to Intuit, very similar to some other stocks we looked at tonight. Net debt to capital is 37%, so that's not terrible. Interest coverage is 13.7. So I think everything that I see just from the raw numbers perspective, Triven, looks good. I want to spend a little time with it and kind of look at the strategy and the management team and how they're kind of handling all of that. But I'm going to add that to my model. Probably. It looks good. I like those numbers. I appreciate you sharing that because it's a pretty decent stock, man. So with that, we're almost at our 1 hour time frame here. So I appreciate you guys joining tonight. I do always look forward to hanging out with you guys and talking some stocks. And hopefully, we can all win together because that's what this is about. And so Triven's helping me win by putting me on the fact set here. So I appreciate that, man. Yeah, it looks like a buy. That's what my friend Fast Eddie says here. So I don't ever like jump really fast on anything, but it's certainly something I'm going to look into more. So like I say, I don't mind having up to 25 stocks in the portfolio. Right now, I've got 21 and I have right at $100,000 in cash that is not invested. So I'm looking for areas to park that. And in fact, SEP might be one of those. So thanks for passing that on, my friend. I appreciate it. With that, I'm going to let you guys run, and hope you have a great week. Stay alert, stay invested, and let's make some money together, guys. Hey, I'll talk to you soon.